Well, meantime, Oracle shares popping here in overtime, just off session highs after reporting an earnings beat. The company saying expect fiscal 2026 revenue to be dramatically higher as it benefits from AI and cloud services. That earnings call kicks off in just a few minutes. And joining us now is Brent Thill, Jefferies tech research analyst, has a buy rating on Oracle. Brent, welcome. So we're just talking about CoreWeave, and people might not think of Oracle as an AI infrastructure provider, but the argument in this report, I guess, would be that it is total cloud growth rate, applications plus infrastructure. Software Cats is saying here is going to increase from 24% to more than 40% in fiscal 26. How important is that?
Oracle had a great print, John. And as they say, the last 20 years, you never want to bet against Oracle in their fiscal Q4, which ended May, and they just put up another great Q4. They are an AI beneficiary, there's no doubt. They obviously are fighting against giants with Microsoft, Amazon, Google, but their strategy is very different and unique. And the most important comment of this entire report is 100% backlog growth expected in this next fiscal year. That is materially ahead of the 41 they just did. And it tells you that they've got a lot of big contracts in AI coming to them over the next year. Obviously, everyone's been talking about Stargate down in Abilene, Texas. When does that turn on? You would assume this growth in the guide that it assumes some Stargate revenue, as well as some of the other big AI companies. So, yeah, they're not participating at the same market share as Amazon and Microsoft, but they're certainly doing a really good job. And because they're the lowest share provider today in terms of market share, they actually have the chance to grow the fastest. And so, really good growth. I think the highlight of the entire release so far has just been the backlog commentary, which tells you this AI trade is alive, kicking. There are no constraints. There are no concerns over what's happening in the economy around AI.
But it also, doesn't it, makes Oracle less of a software comp to Adobe. I mean, it always was a different type of software than Adobe, but Adobe moving more into enterprise, and investors really waiting to understand the Firefly growth model and to what degree that will monetize and how soon.
Yeah, Adobe's got the worst sentiment of all large cap software. It's amazing. When you talk to the users of Adobe, they love it. When you talk to Wall Street money managers, they hate it. And so there's a disconnect. And I think Adobe has to continue to execute, show double-digit growth, show that they can continue to hold the mid 40% margins, and show that they're not AI roadkill. And right now, Wall Street's made its mind up that effectively all these new AI models are going to run Adobe over. Our research says that it's not. It's the cheapest name in large cap. We think that no one likes it. It's been hard to change the sentiment. It's going to take multiple quarters for Adobe to put up good numbers. But we adore this management team. We think they're one of the best. We think they're doing the right things. They just have to keep telling the message, and at some point it's going to get recognized. Again, it's the cheapest name we cover in large cap at 15 times EBITDA. So I think if they can just hold the double-digit growth, it's probably going to be good enough. I don't think they're going to put up numbers like Oracle just did, but I think, again, just holding to their script should be enough, because the embedded expectations for Adobe are massive decel. AI is going to eat them, and they're just roadkill as it relates to AI. And again, I don't think that thesis is really true.
Let's talk a little bit about remaining performance obligation, because in the case of Oracle, they're talking about expectations that that's going to grow 100% in fiscal 2026. At a time where you are seeing so much uncertainty, volatility in the market, does it make a name like Oracle feel a little more defensive even as it grows?
I think so. I mean, it's a re-accelerating growth story. Wall Street loves re-accelerating growth, so they check that box, and then they have 40+% margins. And while margins should contract because of the investment in AI, they're still well north of 40 and well higher than the majority of their peer group. And so we think they're in good shape. As it relates to the economy, I don't think any CEO or CIO is saying, I'm turning my back on AI. Jamie Dimon spoke, the CEO of JP Morgan, at a Databricks conference today and said they're going to spend $2 billion in AI this year, and that number could double or triple in the next year. So these are huge numbers, and one of the biggest banks on the planet says they're going to double or triple their AI budget. Tells you a lot about where we're at and where big firms are going with AI. And we think Oracle will be a foundational piece, along with Microsoft along with Amazon as other core names that we want to own.